Welcome to the ETF Show, taped here from Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, markets have been on a roller coaster lately as anxiety over AI disruption and perhaps even elimination of software companies has triggered sell-offs in the tech sector. XLK, the Technology Select Sector Spider Fund, has seen outflows of nearly $2 billion in just the last month. And the largest software ETF, IGV, that's the iShares Expanded Tech Software Sector ETF, has massively underperformed the broader market, sinking over 24% since the start of the year. Now, a research note from Zacks Investment Management put investor fears quite succinctly. It said, quote, "What happens if AI doesn't just enhance software, but begins to compete with it?" Joining me now to discuss is Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Brian, thank you so much for joining us.
Absolutely. Thank you so much for having us.
So let's start with the question that is put in the research note from your firm. How real is the threat that AI is going to compete and not just enhance software?
So, what we've seen over the last couple of weeks from Anthropic and in particular Claude is that AI is now able to program itself. And so, what we have is this world of AI bots versus AI agents. So, the agents that live in the cloud from the traditional software providers versus the bots like Claude that are programming themselves to do more useful tasks more quickly. So, that threat is real. The real question for investors, though, can it be done at scale? And that's where I think that there's a little bit of a mispricing event here, and that yes, there's innovations, there's new things happening, but at the same time, it's not happening at scale.
All right, so let's talk about that because what we've been seeing in the markets then, are you thinking that it's a bit of a market overreaction or is there, real structural disruption that is going to be happening to these software companies' business models?
The competition is real. There's no doubt about that in my mind. But at the same time, I don't think Microsoft is going away. What's going to happen in this environment is you're going to have a choice. If you want to run an AI bot in house that is customized to your business and doing what you want to do, you're going to have all of the memory and the hardware on premise and bear that burden of the cost. Or you can go with what AI has been recently on the AI agent side and partner with Azure in the cloud business or AWS or something along those lines. They have scale and the ability to provide pricing advantage, but that data lives in the cloud off of your premise, and that allows the home office, if you will, at Microsoft and Amazon to use that data to program its models and get better at large versus containing it in house.
So then in your mind, it sounds like there's the possibility, really, that AI can actually create new demand and new opportunities that could mitigate some of the losses that might come from cannibalization, correct?
Yeah, absolutely. All this means is that there's going to be more choices for businesses and consumers in that how they want to interact or adopt AI in their own either their practice as a business or in their own personal lives if they were going to use it as an assistant. So that competition is good. The space is large enough and there's enough money out there that you could actually see this wave of innovation start to lift all boats. The market is just overreacting in this moment in that they believe software is dead forever. We just simply don't buy into that.
What about those more niche or single point software companies? Do they survive in a moment like this?
Well, I think the real leverage point is scale. If you have a large enough operation and enough of a client base, yes, I think you'll probably survive. But if you're overly dependent on one type of client or one particular product, those are the ones that could get picked off by AI bots.
Now, I mentioned earlier that funds like IGV are massively underperforming. That's really putting it mildly, right? Down over 23% compared to the S&P 500, which is up about 1% at least year to date. But at least when looking at that fund and looking at other software ETFs, they remain inflow positive. IGV pulled in over $1 billion since the start of the year. What does that really tell you then about the investor sentiment and behavior to see so much money being raked in by these funds, despite the fact that their performance lagging not only the S&P 500, but even the technology selector more broadly?
It's a fair point. I think two things can be true at the same time. One, late in November, all the way through the end of last year, we had a pretty big rotation from large cap growth to large cap value. That hurt all of this sector at the same time equally. But also, we do see pressure based on this new AI bot environment that is hurting the software reputation, if you will. So I think we had a little bit of both. We had some people repositioning their portfolios, taking a little bit of embedded gains after the last 3 years, and the Mag 7 have done so well, and they're repositioning that into other places. But that doesn't mean there's less excitement or any less momentum in AI as a tradable or an investable space. It really is going to still be a transformative technology. And now what you're talking about, some stocks are on sale.
So then let's talk about concentration risk because it sounds like investors are still, making that long-term bet, right, on the resilience of software and on companies. As you mentioned, Microsoft probably isn't going anywhere. But when it comes to like concentration, ETFs like XLK, they have been seeing these large outflows. Do you think that's a response to the concentration in tech? That's been a really big question for a lot of investors this year and also last.
Yeah, I think there are some worries out there. When you start to look at the Mag 7 individually, you can start to see where winners and losers are forming up. We all know the capex has driven the market higher in such a big way over the last 2 years, but this earnings season in Q1, these huge expenditures have turned into a negative sentiment for investors. Amazon is a good case in point here, where they increase their capex for the year and the stock price goes down. When you look at their free cash flow over the last 10 years, they've actually been negative 3 out of the last 2 years in free cash flow. That means they're just spending everything that they make to try and grow the business. What investors like us want to know is, when does that capex come back to the balance sheet in form of revenues, and will those revenues be profitable? The difference being in Microsoft's case is that they've always been cash flow positive, and they now have the Azure cloud business big enough to finance all of their capex commitments on its own. So the rest of the business units remain their profitability. So this is the dividing line, I think, in the moment of winners and losers. As we go forward, the innovation process obviously could be a catapult for any one of these names if they solve one of these problems better than their competitors.
You're really touching on something that I think has been discussed definitely over the last year, something that's been considered by investors into this year, which is frankly valuations, right, in the market right now. So when we're looking at least at this segment, and particularly when it comes to AI, do you think that the valuations are accurately assessing the AI risk? Is there more downside, do you think, to be considered when it comes to some of those valuations?
Yeah, when we look at just technology, XLK, for example, with a PE in the high 30s, whereas the rest of the market is in the low 20s, then yes, that shows me that there could be some risk if we just have some normalization, right? If there's mean reversion in that valuation, that means that the next 10% could still be to the downside, even though we're down 20 in a lot of these names. At the same time, all it would take is some positive news, right? Somebody solves a problem better than somebody else. It's a competitive environment, and then we're back to more of a risk on type of trade in that moment.
I want to talk now a little bit about ETFs within this software segment. I'm curious to know if you think that they're accurately capturing, the AI winners, or if investors really need to be a little bit more selective in their fund choices, really lift up the hood and kick the tires a little bit.
Well, in our large cap growth ETF grows, GROZ, we're still 64% committed to technology, but it comes in different shapes and sizes, right? There's some of these AI adjacent businesses that fall inside of this that are benefiting from the hyperscalers spending. We're looking at $640 billion this year in 2026 to expand AI compute. And I think that's one of the biggest things that you can capture right now in this moment, is that the lack of computing power is the biggest limit to AI growth. Demand remains strong on either side, whether you're on the AI bot or the AI agent. There's a lot of demand for those products, but it's being slowed by the lack of compute. That means you can turn to some of these highly technical companies that are going to be providing either electricity to data centers or doing some of the more intricate hardware connectivity work, where you can invest in some of these names at a much lower valuation that are benefiting directly from the capex spending. So that's a way to go underneath in your technology, slice of the pie, and still drive positive returns.
I'm curious to know a little bit about performance dispersion, right? That could start to exist within some of these funds. As we're just mentioning, right? There's going to be a lot of companies that are very clearly going to become the winners of this AI game. But then there's others that are really going to be facing some serious risks and some serious headwinds. For ETF investors, right? How should they try to navigate that environment and those widening dispersions, at least when it comes to performance of some of these stocks that they're investing in as a part of these larger funds?
Yeah, it's a great question, and it's going to take a little bit longer view. Winning, in our definition, is the company that's going to be profitable. Just like back in the late 90s, what happened in the technology bubble during the internet phase was a lot of unprofitable companies with a lot of exciting ideas had their stock price blow up, but they never backed it up with any type of revenue or earnings growth. And so, in learning from that 25 years ago, what we can translate today is the winner long term are going to be those companies that not only solve this problem, but find a way to do it profitably.
Now, active management has absolutely exploded, and we've seen interest in active management really explode, especially through the times of volatility. So, do you think that active strategies are really best positioned to manage the risk that, AI poses, or passive strategies still better suited for this kind of disruption?
I think we turned that corner late last year. What we've seen is we've had 6 interest rate cuts from the Fed, but the 10-year treasury remains above 4%. That means the cost of capital for a lot of these technology firms that are trying to grow remains restricted. We've also seen that translate into a large number of public bankruptcies, over 1,000 public bankruptcies last year. That's doubled in the normal trend, if you will, in this moment in time. So there's a lot of bad stuff out there in this market that you need to be avoiding. We can do that better on the active side than what you're capturing on the passive side, which is just that you own a bunch of stuff that is low quality, not profitable, along with a few good names.
How are you seeing these, software ETFs being used right now in portfolios? Are they part of core holdings, or are you really seeing them being used as more tactical vehicles?
I think that there's a shift going on right now, over the last couple of weeks. People are seeing opportunity and they're tactically overweighting a beaten down sector. But over the long term, again, these names are not going anywhere. Even though I was picking on Amazon, they're certainly a high quality company. Microsoft isn't going anywhere. These are good names that you're going to want to own over a long period of time because of the breadth and the scale of their balance sheet in this moment.
Now, last question for you, Brian. I'm curious to know, for any investors or advisors that are watching right now. You were talking a little bit earlier about the portfolio reallocations that have been sort of going on. Considering the volatility in tech, what should a lot of investors and advisors really be keeping in mind before they start to make some of these portfolio reallocations?
It's always exciting to see this type of wave of innovation. And there's definitely some very positive use cases out there that we've seen over the last couple of weeks. One was, a guy programming his own bot to buy himself a car, did a magnificent job. Now we have a bigger scale in that Claude Legal is going to replace all of the attorneys that are out there, right? So what happens in the market is some of these ideas get adopted very quickly and emotionally. And the reality is they will be disruptive change in terms of the AI bots, but it doesn't happen all at once. So the reality is there's going to be a competitive cycle here, and there's enough investable dollars to create positive returns on both sides of this question, bots versus agents.
All right, Brian Mulberry, Senior Client Portfolio Manager for Zacks Investment Management. Thank you so much for joining us, and thank you so much for tuning in to the ETF Show.